With record unemployment rates and government assistance programs that often aren't enough, Americans across the country are wondering how to cover their bills during the coronavirus outbreak.
An ABC News Washington Post poll showed half of Americans have experienced a cut in pay or work hours.
Nearly 10 million Americans filed for unemployment insurance claims during the final 2 weeks in March, the highest level on record, after they were let go from their jobs as their employers dealt with the impacts of the virus.
Millions are feeling its effect on the workforce.
Some are even considering taking out a personal loan to cover expenses they can't put on hold, like groceries, insurance, and rent. While a personal loan can help you save if you're struggling with high-interest credit card debt, it might not be a good option for everyone. Taking on debt to pay off this month's bills will only add to your expenses in the coming months and could land you in a worse situation than you were in before. It can also be harder to qualify for a personal loan now than it was before COVID-19 hit, thanks to the shaky economy. We spoke with Richard Tambor, the Chief Risk Officer at OneMain Financial, about the state of the lending market and whether now is a good time to take out a personal loan.
If now feels like a good time to do debt consolidation and try to get your put yourself in a place where you can have a clear visibility to paying off your debts through a fixed term loan, then it's a great time to take a loan. If you've got lots of personal uncertainty in terms of your job or your health or anything else, then maybe it's not. But each situation is unique.
If you think a personal loan could help, think about what type of lender you want to apply with. Different types of lenders can benefit different types of borrowers. For example, borrowers with good to excellent credit, that's usually a score of 670 or higher, can often find the most favorable rates and terms with a bank. But if you have fair credit, that's normally a score between 580 and 669, you might have an easier time qualifying with an online lender. Beyond fair credit, we asked Richard who the ideal borrower is to get a good rate on a OneMain personal loan.
Our customer segment is, we'll call them non-prime hardworking Americans. So if you just look at the profile of our customers, they really look like Main Street America. They're, average age in their 40s. They have stable employment, stable time at their homes. They have credit files. They've got bank accounts. But at some point in the past, they may have had a credit issue, either because of, for any number of reasons that people have credit issues.
But even if you were able to qualify for a personal loan before the pandemic hit, that might not be the case now. Due to unstable employment throughout the country, income is no longer a reliable indicator of whether a borrower can afford to pay back their debt. And with many Americans taking advantage of deferment and forbearance programs on their student loans, car loans, credit cards, and other bills, lenders expect a wave of defaults once repayments kick in again. If this happens, they stand to lose a lot of money. This has caused some lenders to use stricter eligibility requirements and offer fewer loans. We asked Richard how this is affecting the lending market.
Most lenders have pulled back. Virtually everybody that I know has pulled back credit because of the incredible uncertainty in the environment. You see unemployment rates getting up into double digits, and 40 plus million people have filed for initial claims for unemployment. That's a lot of uncertainty, and lenders are not people who love uncertainty. So we and everybody else have pulled back. So that's feature number one. Feature number two is, and this, I can't say that I fully anticipated this, but consumer demand really pulled back. It pulled back hard in March and April, where I think the shock of the pandemic and the shutdowns of broad swaths of the economy and the uncertainty for consumers and fear caused consumer demand to drop off. So rather than consumers going out and saying, hey, I better get some more cash and take on new loans, consumers went the other way. And they said, I'm just not going to look for credit.
Even with the changing lending market, there are still a few steps you can take to help you decide if a personal loan is the right choice for you. First, check your credit report and go over your budget to get an idea of how much you can afford to pay each month. If your credit score is below 580 or you don't have much wiggle room in your budget, you could have a hard time qualifying. And exhaust your other options before you decide to take on more debt. For example, if you're struggling with medical debt, try negotiating the cost with your provider or ask for an interest-free payment plan. Some local governments also have financial assistance programs available for people who have lost income due to the coronavirus outbreak. If you can qualify for one of those, a loan might not even be necessary. If you do decide a personal loan is right for you, click here to check out our video where we break down the best lenders out there. And don't forget to subscribe to our channel for other videos on personal, car, and business loans. Thanks for watching.